nothing goes up forever. Today, we're going to talk about the potential for a near-term correction, and by that I mean in the next couple of months. We're going to talk about why we should have some cash and buy into that correction, and why the market is likely to head up after such a correction in 2026. I'm going to give you some signs to watch for when the correction may be setting up to happen on a near-term basis. And then I'm going to give you some strategies on how we are positioned at ValueTrend to take advantage of this year's movements. My name is Keith Richards. I'm President and Chief Portfolio Manager at ValueTrend Wealth Management. And this is the Smart Money, Dumb Money Show. And you guys, you know you're smart money. Okay, to start, let's talk about, in the longer run, why we should stay in the market despite corrections. The corrections, when we see them, are opportunities to use whatever cash we have to buy in. And this is a chart that I have been showing my viewers and readers of my blog at valuetrend.ca for many, many years. In fact, this chart goes back to 2007 when I began drawing my lines on it, and I want you guys to pay heed to the lessons seen on this chart. And what it is a chart showing us Federal Reserve movements in monetary policy and the S&P 500. You guys have heard the expression, I've talked about it before, don't fight the Fed. This chart offers proof that when the Fed is easing or using quantitative easing or monetary rate reduction dovish policies, the market almost invariably goes up. So we don't want to fight that. Conversely, when the market starts to tighten, I should say when the Fed starts to tighten or when the Fed discontinues its easing program, the market almost always reacts with a correction. This has been happening since 2007, so it's not new. So let's take a look at this chart. You can see my various lines. In fact, this chart goes back before 2007. I'm going to just show you from 2007 and on. I have been drawing these annotations on the market for decades. But what I want to show you here is that when we go back to 2007 and then we saw the market crash of 2008-9, the Fed began to ease and do what's called quantitative easing. They use something called Operation Twist. It's basically buying bonds back on the market or trading durations to add more liquidity to the markets. And this invariably sent markets up. But what's interesting is when these programs end, so when QE1 ended, the market corrected. When QE2 ended, the market corrected. So we want to stay in the market as, for example, QE3 here began and the market trended up. Whenever these easing programs discontinue, you can see a flat or very choppy or even negative market. So rather than go through each and every example, although I do have them outlined on this chart, we can see that basically stimulus and monetary policy pushes markets up. So blue is good. Red, which is when tightening is announced, is bad. Well, where are we right now? The Fed cut in 2025. It's expected to cut in 2026. So we don't want to fight that. The market will generally trend up, but that doesn't mean it will never correct in the near term for shorter term, lesser extentful corrections. So that's what I'm expecting. And this chart shows us why we need to buy into that potential correction if it happens. Okay, so one of the things that I look at as a technical analyst is the 200-day moving average. Now, the 200-day moving average or 40-week moving average will tell us if the market is in an uptrend or a downtrend or trading sideways. Well, we can also use that moving average to determine if the market is overbought or oversold or not. My general rule is on a market, not on a stock, but on the market, say a wide index like the S&P 500 or the TSX 300, if the index is more than 10% over the 200-day / 40-week moving average, we're starting to get into an overbought position. So I want to take a look at both the TSX and the S&P. On the right-hand side, I'm going to focus on the S&P first. The S&P 500 currently is about 9% over its 200 days. So it's approaching my 10% rule. It's not mega overbought, but it's getting there. But if we go to this left chart, which is the TSX, it's 13.7% at the time of recording this video over the 200-day moving average. The 200 is this red line. So we're definitely very overbought on the TSX, and you can kind of see that the S&P has been a little bit flat. It is at new highs, but it's kind of meandering, whereas the TSX has been a rocket of late. And that does tell us that it's a little overbought, the most likely candidate to have a near-term correction. So while we're on the topic of the TSX, let's take a look at another couple of technical indicators that might indicate that it's a bit overbought. We're going to look at some momentum studies. Momentum is basically just a study of how fast the market is moving, up or down. If it's moving too fast, it gets to a point where we call it overbought. And when it starts to roll over in momentum, meaning that momentum is slowing down, we call that divergence, and that means that market participants are becoming less interested in pushing the velocity of price increases, and that often means a correction. So let's take a look at the TSX. This is money flow, this top pane, and you can see that the market got quite overbought from a money flow point of view, the amount of money that was flowing into the TSX, and has since diverged negatively on the TSX. This is MACD. MACD, again, has been trending up, but the histogram is telling us that things are slowing down. And RSI as well, very overbought, no doubt about it. RSI, which is a midterm momentum indicator, price momentum indicator, is telling us things are overbought. They can stay overbought for a while, as they have, as you can see, but eventually that will tend to correct itself. If we look at the S&P 500, you'll see similar but not quite as extreme. You can see that money flow, not quite as overbought, but has been losing steam. And MACD, unlike the TSX, is definitely losing a lot of steam on both the histogram and the MACD lines themselves. This is telling us that momentum is slowing down, and you can kind of see it because in the S&P 500, yes, it's making new highs, but if we zoom in, the angle of ascent is nowhere near what it was on the TSX. Final thing is the RSI. It never really reached super overbought, but it definitely hit the overbought line, and it has been moving down as well, diverging negatively. This tells us that market participants are starting to wane in their enthusiasm. They're still pushing prices up, but enthusiasm is slowing down. Okay, a couple of big picture momentum indicators. I'm going to start with the put to call ratio. I've talked about this on the videos before and on my blogs. It's a very common thing to look at. It's the ratio of how many puts are being traded versus calls on the market. There's a certain level that's considered normal. We can get to extremes. Too many people buying calls, as we have right now, versus puts means complacency. If we look at the put to call ratio chart during market extremes, such as 2008, we can see that there's a lot of fear. People are buying puts aggressively. Why? Because they're fearful. When things get complacent, so in other words, people are thinking things are good, then markets can often show very little put to call ratio. In other words, far too many calls are being bought versus put. Lots of white space up here. So that was the case in 2021, just before the correction in 22. You know, we had about a 25% correction over the year of 2022. And then, of course, as volatility and prices fell, investors began buying more and more puts. So that ratio went up. When it reached an extreme, boom, down again. So where are we now? Well, the put to call ratio has been hovering in that complacent level where there's not many puts being bought and there's lots of white space up above. What that means is that investors don't have a lot of fear that the market's going to fall, so they're not buying puts. Now, it's not just ordinary retail investors that feel a little complacent right now. The National Association of Individual Managers are holding less cash. They're fully invested. I've talked about this indicator many times in the past, but effectively, professional portfolio managers as a group, I don't like to feel that ValueTrend is necessarily part of that group, but professional portfolio managers as the group become very fully invested and right into and at market tops. And funny enough, when markets are making bottoms, they're often underinvested. You can see that here, right at the bottom of the correction in 2022, portfolio managers were holding very little equities compared to their norms. But prior to that correction, they were holding extremely high levels of equities. You'll see this over and over again. I'm going to just take a look at 2009, the bottom. They were very underinvested prior to the correction of 2008-9. They were fully invested. So where are we right now? Investors are fully invested, or I should say investment managers are fully invested. This can last a while, as we've seen historically, but it's a sign that portfolio managers are complacent. They think that the market's going to keep going up. There's no fear. And on the topic of lack of fear, we can take a look at volatility on a stock chart. And we can look at things like the VIX. We can look at things like the put to call ratio and all that kind of thing. By the way, the VIX is around 14. It's fairly low if you know what the VIX is. I won't show that chart today because I've shown it enough times recently. But this chart, I think you guys are going to find pretty interesting. I am showing you here that when markets don't have fairly regular, decent sized swings, things are getting too complacent. The volatility is too low. So let's take a look at historically. We're going right back to 2012 here. You can see that when the trend was up and the swings within that trend were very tight, that is considered a low volatility swing period. And eventually this leads into periods of sideways or corrective actions. You can see that here, 2017. Look at how tight those swings were. In fact, there was hardly any movement during 2/3 of the latter part of 2017. I remember that. And eventually we ended up with a very volatile period for about another year. So we had that same thing in 2021, very low swings. Again, I'll zoom in a little bit. You can see very tight bars. It led into a market top and a correction 22. So if we move over into 2025, we can see the swings have not been very aggressive. Normal swings tend to have decent corrections. We're not seeing that right now. This is a problem for the near term. I think we're due one of those swings. Another factor to keep in mind is seasonality. Now, seasonality is just a tendency. It's not an absolute. But if we take a look at the S&P 500, and I'm using that, you'll see very similar patterns in seasonality on the TSX, by the way. But if we look at the S&P 500 seasonality, you can see that often January is fairly flat. It can be okay, but not necessarily a fantastic month. But leading into February, we often get a spike. So I think that we could actually see the market continue moving up. We're seeing that things are getting a little complacent, a little overbought, but they're not yet showing a rounding over in price. So we could see a little bit more upside. And I think what's going to happen is maybe seasonality will line us up to see some sort of corrective activity in the latter part of February leading into March. So there's maybe a timing aspect to keep in mind. Now, the other thing I want to note is that I did a video a while ago called 4 Investment Rules, and one of them is no flat assertions. So I'm not making a flat assertion here saying, yeah, the market's going down. Remember, I talked about the Buddhist rule of don't know mind. We have to keep an open mind. Anything can happen. We don't actually know what's going to happen, but we're looking at some evidence that there is a little bit of overbought atmosphere on the market right now. And there's some evidence that based on some historical patterns, we could see that overbought market correct in the next month or two. Final thing I want to talk about is consumer sentiment. Now, this is more of a economics indicator, but it does kind of line up with market corrections. And you'll see that consumer sentiment is both a leading and coincident indicator for when markets will correct. So if we go back again, I'm going back to 2007, you can see that we all know that the market corrected in 08-09. So it stands to reason that during that period of time, consumers would be not overly enthusiastic about consuming and purchasing, and they're worried, their jobs are being lost and all that kind of thing. But leading into that, we have a peak in consumer sentiment, and consumer sentiment, people get more and more worried. Eventually, this results in stock markets correcting because, again, the stock market is an indicator of confidence in the economy. And if people are not confident, they will sell their stocks. So you can see what's happened recently in 2024-25. Consumer sentiment has fallen, and it continues to fall to actually very, very low levels. In fact, lowest levels since basically 2008. So we're at a fairly low consumer confidence level, and it's only a matter of time before we get a larger correction on the stock market. But in the interim, I think we're overdue even a short-term correction until the Fed stops easing. When will this correction happen? Well, again, seasonality suggests there's a pattern or a potential for the market to go up until about mid-February and perhaps thereafter start to correct. One of the things I use, and if you follow my blogs at ValueTrend.ca, and I do suggest you do follow the blogs because there's a lot of stuff that I can't talk about on the videos here just because there's too much to talk about sometimes. But one of the things I do is something called my short-term timing system. And it doesn't mean to be a know-all timing program. Remember, don't know mind. We don't actually know what's going to happen, but it tends to signal with a fairly decent amount of probability when a market is likely to correct. Now, how big that correction is the one thing that nobody can tell you, including my short-term model. But one of the things that I will look at is 3 indicators. So I'm just going to use past examples here. And this is a daily chart. So we're going back to October. You can see that the market moved to the top of its Bollinger Band. Now, Bollinger Band is simply 2 standard deviations from a 20-day moving average. So it was at the top of a short-term volatility pattern. At the same time, it was making a peak in stochastics from an overbought signal, and it was making a peak in RSI. These kind of things line up, markets often correct. You'll notice this over and over on this signal that you get these line up, and often there's a correction. You just don't know how deep it's going to be. We're not quite there yet. So I'm going to zoom in a bit, and you can see we're not really at the tippy top of the Bollinger Band. If we take a look at stochastics, it's not really super overbought, and RSI, if we zoom in, is nowhere near its overbought line. With all that in mind, I'm suggesting that the timing on the near-term correction, if it does occur, is not quite upon us. Again, this video's purpose is to give you a heads up as to the potential for that happening in the next month or so. Final indicator that suggests that we're not quite ready today for a correction is the Fear and Greed Index put out by CNN. You can access it free on the internet, CNN Fear and Greed Index, just Google it. And they were pretty good. It's an overall indicator. I think it uses about 11 indicators. I use one myself called the Barometer that's reported every month on the blog at the beginning of the month. And both of these indicators are suggesting fairly neutral ground as far as the market is concerned in the near term. So my Barometer measures 5 out of 8, which is very neutral. It's actually tilted somewhat to the positive in the very near term. And the CNN Fear and Greed indicator is right at neutral as well. So both of us agree, you could say, that right now it's unlikely that we're going to see a very near-term correction, but all of the things we just looked at tell us that we should be keeping an eye open for something to happen in the next month or two. So, current battle plan. Again, keeping in mind that we never make flat assertions. We don't know if there's going to be a correction, but the odds are increasing that over the coming month or two, we're going to see some sort of a pullback. Will that be 5%, 10%? That's something I can't tell you, but historic indicators that I'm looking at suggest that probably something's going to happen in the next couple of months that will probably create a very good buying opportunity. So it doesn't hurt to hold some cash. The other things that I would suggest we do is concentrate our portfolio on value stocks, because we know TSX, S&P 500 are not cheap as indexes. That's largely because of the growth stocks. They've been overpriced. So ValueTrend has been focusing on value stocks. As you know, because I've beaten you over the heads over the past year and a half on this subject, is hard assets. Hard assets have been the place to be. I've been correct on that call. I think 2026, we're going to continue being correct on that call. We are starting to move into international. We've actually been buying international equities through much of 2025. We continue into 26. But interestingly enough, you might be interested to know that we are focusing now on small cap international, and there's small cap international ETFs you can buy. So we like the small cap area, particularly internationally. But we like international stocks overall. We think they're generally cheaper, most of the developed markets versus North American markets. And the final thing I want to keep in mind is that if and when we see any corrections, we should be buying into those corrections because the Fed has made it very clear that they're dovish. And if they are dovish, you don't fight the Fed, the markets will likely go up. So what I'm going to suggest for more ideas is you see my video called Top Picks for 2026. I cover 4 main themes, which includes the international, the value, etc. But I talk about some specific ideas that I'm sure you guys will want to see. Thanks for watching. We'll catch you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.